How do you know when to get out of trades? Very, very important. This is something a lot of traders struggle with, and I'm going to solve it for you today. So we're going to use the MACD indicator for this, a very common indicator. However, a lot of people don't use it correctly. So I'm going to show you how to use it. We're going to do 3 steps, and here in the next 8 to 10 minutes, you'll be a master of how to exit your trade. So step 1, we're going to give you an X-ray into the MACD indicator. So you really understand you should never trade any tool, indicator, pattern, whatever, that you don't really understand intimately. It's your money, and you got to understand what you're trading, what the tools are. Number 2, I'm going to show you how the MACD is a leading indicator, and I know that's very controversial, but I'm going to prove it to you. And then number 3, I'm going to show you exactly how to trade it to get out of trades. All right, so let's jump right into it. So part 1, we want to give you an X-ray into what exactly is the MACD. Now, the MACD has 3 parts to it here, and today we're going to focus actually on the MACD line. So the MACD line is this blue line. Then you've got your signal line, which is the orange line, and then you got your MACD histogram down here. We're going to focus on the actual MACD line today. So what is the MACD line? I told you I'd give you an X-ray into it so that you really understand what it is. So let's get down on it. So all it is, and it's very, very simple. By the way, if we pull this up, let's do this first. If we pull up this indicator, you're going to see that we go to inputs. It is measuring 2 exponential moving averages. The fast is the 12 EMA and the slow is the 26 EMA. These are the default settings. The smoothing signal is 9, and that's the orange line on the chart. So we're not going to talk about that today. We're going to talk about just this. Now, these 2 moving averages create one line. And what it is showing you is what is the difference between those 2 moving averages. So let me show you exactly what I'm talking about. In fact, let me go ahead and remove the other lines just to make this super simple. We'll take off the histogram, we'll take off the signal line. Now we're left with just the MACD line. And now I've already placed on here so that we can look at these, those 2 moving averages. So remember, that's what the MACD line is measuring, is simply the difference between those 2 moving averages. So that's what I've got here. All right, so I've got, whoops. So as you can see here, I've got my 12 exponential moving average. So that's the green line. Okay, that's the faster one. And then here, we've got our 26 period exponential moving average. And that's it. That's the X-ray. That's how to understand that. That's what it literally is. So indicators are math formulas. That's what they are. So all this line is doing is measuring the difference between these 2 moving averages. It's that simple. So if you look at this, and I'm going to show you how to apply this, obviously, and what the practical application is. So if we look at this puppy dog, you'll see that the further that there is a distance between these 2 moving averages, see how they get further and further and further apart? Okay, that's when this MACD line goes up and up and up and up. Now, when they start getting closer together, okay, now they're getting closer together, less distance, and then the MACD line starts going down. So now you understand what it is actually measuring. And that's that simple. And again, anything you trade, you bet it's your money. You better understand what tools you're using and what they literally mean. Okay, so that's step 1. Now, step 2. Why do we say that it's a leading indicator? The reason I say it's a leading indicator is that it is measuring acceleration of price. That's what it's mathematically measuring. So we see here, for example, very famous thing that everybody talks about, where you get higher high, higher low, higher high, and people say, okay, we're in an uptrend, and therefore we would be looking to buy the next retrace. So yes, we have an uptrend, but that's just one energy of the market. All trend means is direction. The next question is, what is the strength of that trend? Or in this particular case, what's the acceleration? Is it accelerating with that new that higher high? Or is it decelerating? Is it slowing down? So that's it, the speed of that higher high. So let's take a look at that. And, oh, by the way, so you notice I took off the MACD here. I did that very intentionally. So let's put it back on. And we'll come down here and put it on. Okay, so now what you can see is, sure, we had a higher high on price, but when you look at the MACD indicator, it is showing us that, oh no, we have a deceleration in the price action. So yes, higher highs, let me take that off of there because I kind of messed up when I moved the chart. So yes, we do have higher highs as far as direction, but this higher high is on weakness. The market is not having the same acceleration here that it did here. And therefore, this is what we would call a weak move up. We only want to buy when there is strength in the direction. Direction is not enough. You need to add whether there is strength or weakness in that price action, very simply. So if we go back over here, okay, and you can see, sure enough, comes back down. In fact, we actually took out these lows over here. So this low where we had this higher high, higher low, higher high. Okay, we had these lows here, and yeah, we took those out pretty handily. So this would be a great place to get out. All right, now let me go and let's cover number 3, and that is, let's go into a little more detail about exactly where to exit your trades. So the last example that I showed you, we saw that the MACD line was flatlining. So there was deceleration. There was a higher high, but deceleration. The better signal for exits is actually a divergence. So this is part 3. And what we're looking for here is to, first of all, get those lines off of there and create new ones. So we go up here and we've got a double top now in this particular case. So all of this is great, right? By the way, look at all this. So first of all, higher high, higher low, higher high, higher low, higher high, higher low, higher high. Now, this is what I wanted to point out. So right here, we do have equal highs on the MACD line and a higher high on price. So there is deceleration here, and this is key. That is really not enough to get out of a trend trade. You might take partial profits there. You might want to take partial profits, but I wouldn't take my final shares, contracts, lots, whatever you're trading, off of the trade there, because trends can accelerate and decelerate while the trend continues up. So just like we know, there is accumulation, distribution, but there's markets go up and then they go sideways. They go up and then they consolidate, right? So during those consolidation times, that's when you will see deceleration of price action. And so that's not enough to take a trend reversal or to get out of a trade. The better signal is this, and you can probably see it already because all y'all are smart, and some of you are already ahead of me on this, which is great, by the way. Congratulations. So we've got a double top here, but we have a lower high on the MACD. So now you understand, first of all, what this is measuring. What it's measuring in step 1 was simply the distance between these two moving averages. That's it. It's that simple. Nothing magic about it. Just pure simplicity in its mathematics. Number 2, when it starts to go sideways, there's deceleration. Notice here again, it goes sideways, but we still go back up, and we, even after this sideways movement or this equal high here, we still go back up in price. But is going up on weakness. Okay, this is showing weakness here. And therefore, when it actually turns over and comes down, that's the time that we want to go ahead and exit the market. Now, remember I said that I would show to you and prove to you that this is a leading indicator. And that this is the definition of a leading indicator, where we get a lower high on the indicator before we get a lower high on price action. Before. Definition of leading is before. So if I take this off here, let's look at this real quickly. And sometimes you will see this. The best way to look at any type of price bars, by the way, is to look at the real bodies. The highs don't really matter that much, the top of the wicks. So we want to look at this high over here. And good thing I can draw a steady line there. And so we're matching, close enough for the market because the markets are noisy. So we're coming up here and we make an equal high, double top, if you will. But this move up is on deceleration. And we can tell that because before we get a lower high on price, that's it, that's the operative word. Before we get a lower high on price, we do get a lower high on the indicator. That is the definition of a leading indicator. And that's all she wrote. So if you enjoyed this video, subscribe. Become a subscriber to the channel. I do many, many videos like this, free tutorials teaching you real practical things like this. And when you subscribe, then you get notified every time that I publish a new video. Also, if you want to get my cycle indicator, where I actually help you time to the penny, to the pip, to the tick, I mean literally to the pixel on your chart, when to enter. So today we talked about exits, but I also have a entry tool, and I give that away for free as well. So go to indicatorwebinar.com. It's a recorded webinar now, so you can watch it anytime you want. It's absolutely free. I share with you that indicator, how to trade it, just like I did here. I show you the logic behind it so you really understand it, how to set it up on your charts, and the patterns, just like we showed today a pattern. I show you the patterns on the indicator and how to trade it to get in with precision entries. Go there right now, get it, indicatorwebinar.com.
Stop this bit. It's sad.